All right, welcome to our explainer, where we try to untangle some of the really complex systems that are kind of secretly running our world. Today, we are pulling back the curtain on one of the most powerful, yet, let's be honest, least understood institutions on the entire planet, the central bank. You've seen this headline, right? 1,000 times. It pops up on your news feed, some talking head on TV mentions it, and then everything seems to change. But what does it actually mean? Because what follows that headline is very, very real. All of a sudden, your savings take a hit. Borrowing money for a car or a house gets way more expensive. And companies start talking about, slowing down hiring. All of this happens because of a decision made in a room you will probably never, ever see. And here's the kicker. You don't vote for them. You might not even know their names, but their decisions can have a bigger impact on your wallet than almost any politician. So who are these people? Let's dive in and find out. Okay, so to really get a grip on their power, we first have to figure out what a central bank actually is. And just to be clear, it's not the bank you go to for a loan or savings account. Nope, it operates on a much, much higher level. The easiest way to think about it is like this. If your local bank is like a manager, the central bank is the CEO of the entire financial company. It doesn't deal with us, with everyday customers. Instead, it manages the banks we use, the big names, controlling the flow of money completely behind the scenes. And look, this isn't just an American thing. Not at all. Almost every country has one. In the US, you've got the Federal Reserve, or the Fed. The European Central Bank manages the euro. You've got the Bank of England, the Reserve Bank of India, and on and on. These are the hidden financial engines of the entire global economy. So, how in the world do these institutions have so much influence? Well, it all comes down to three main tools they use to steer the entire economy. This is where their real power is. It's these three levers, setting the price of borrowing, literally creating money out of thin air, and acting as the ultimate safety net for the whole banking system, that allow them to either speed up or slam the brakes on the economy on a massive scale. This is such a great way to think about their most famous tool. Just imagine interest rates are the gas and brake pedal for the economy. When they raise rates, they're hitting the brakes. Borrowing becomes expensive, so people and businesses spend less. This cools down an overheating economy and helps fight inflation. On the flip side, when they cut rates, they're hitting the gas. Borrowing is cheap, spending is encouraged, and it gives a weak economy a much-needed boost. Now, their second tool sounds like something straight out of science fiction, creating money from thin air. And we're not talking about printing presses anymore. Today, money is mostly digital. The central bank literally just creates new digital dollars, and then it uses that new money to buy things like government bonds from commercial banks. This floods those banks with fresh cash, which makes them way more willing to lend money out to you, me, and businesses, getting the whole economy moving again. And when a real crisis hits, they take that money creation and put it on steroids. This is what you hear called quantitative easing, or QE. It's the same idea, just on a scale that is absolutely massive, designed to pump huge amounts of cash into a failing system. So what's the catch? Well, critics argue this fire hose of new money often just flows into assets like stocks and real estate, driving up their prices and making people who already own those assets, a lot richer. Okay, so we know their tools. But that brings us back to our original question. Why does the stock market have a complete meltdown when these people simply talk? And this is a perfect example. Investors hang on every single word. Back in 2021, the US Fed chair said inflation was transitory, just temporary. So the market stayed pretty calm. But just a few months later, he changed his tune and admitted it wasn't going away. That one shift in language sent markets into a total nosedive because investors suddenly realized the brake pedal, those higher interest rates, was coming a lot sooner than they thought. And remember, Wall Street's panic is Main Street's problem. This isn't just some abstract numbers game. When the central bank raises rates to fight that inflation, it translates directly into higher monthly payments on your mortgage and your credit cards. Businesses also face higher borrowing costs, which can lead them to cut spending and, in the worst cases, lay off workers. It's all connected. With this much power, the stakes are just unbelievably high. Central bankers are human after all, and when they make a mistake, the consequences can be catastrophic, affecting millions of lives for years and years. I mean, think back to the lead-up to the 2008 financial crisis. To get the economy moving after 9/11, the Fed hit the gas pedal. And they hit it hard, keeping interest rates at a historic low. This made money incredibly cheap to borrow, which fueled a total frenzy of home buying with these easy, often super risky loans. The result? A massive housing bubble that, when it finally popped, triggered a global financial meltdown. But here's the thing, these tools have their limits. Take Japan, for example. For decades, its central bank has held the gas pedal to the absolute floor, keeping interest rates near zero to try and jumpstart its economy. But it hasn't really worked as planned. People, kind of scarred by a past crash, chose to save their money instead of spend it. So the policy failed to create strong growth, but it did succeed in fueling a mountain of government debt. So all of this immense power and the very real potential for massive mistakes leads to a really controversial question. Who do these bankers actually work for? Who really owns them? The structure of the U.S. Federal Reserve, for instance, is famously confusing. The main board is a public government agency. Its members are appointed by the president. But it also has these 12 regional branches that are technically owned by the private commercial banks in their districts. This strange public-private mix is a huge source of suspicion for a lot of people. And the Fed's origin story only adds fuel to that fire. After a banking panic in 1907 that was so bad the government itself had to be bailed out by one man, the banker J.P. Morgan, a group of top financiers and officials met in total secrecy on a private island. The plan they cooked up there eventually became the Federal Reserve. This history fuels the biggest critique, that it was an institution created by bankers and maybe, just maybe, for bankers.
So here's the bottom line. We have an institution with the power to influence your job, your savings, and the cost of every single thing you buy. Their decisions can create economic booms and busts that define entire generations. And yet, they operate independently, totally outside the direct control of any democratic process, which leaves us with a really fundamental question. Should anyone have that much power?